Disclaimer. All contents, ideas, opinions, and information shared or implied herein are for informational and educational purposes only. Hello everybody. Welcome to Sunny the Eggman YouTube channel. In this video, we will be revealing on top 3 Singapore banking stock to buy in 2021 based on our analysis. Before starting, please help to share and subscribe this channel, as your support is our biggest motivation to continue on producing quality contents. Just a simple and summarized briefing on the banking stock's performance in Singapore for the past 1 year. Generally, the share price for banking stocks in Singapore is experiencing a sharp drop during COVID-19 pandemic in 2020. This is mainly due to the chain impact on the economy sectors disrupted by the pandemic, as many of the businesses ceased operations and unemployment rate increases. We all knew that banks giving out loans to businesses in different industries and earn revenue, if the overall economy is in bad condition, then it will significantly impact banking industry and reflect in the underperforming financial results. In Singapore, the Monetary Authority of Singapore, MAS, together with the Association of Banks in Singapore, ABS, and the Finance Houses Association of Singapore, FHAS, announced on the support measures such as loan moratorium to businesses and individuals, which allow them to defer their loan payment and restructure their loan commitments if need be. This directly causes banks to delay in receiving the interest payments, which serves as one of their big revenue streams. Also, in July and August 2020, MAS calls on banks to cap their total dividends per share for FY 2020 at 60% of FY 2019's DPS, and offer shareholders the option of receiving the remaining dividends to be paid for FY 2020 in shares in lieu of cash. This is a preemptive measure to ensure that banks have strong lending power to support Singapore economy throughout the pandemics. Nonetheless, it also raised concerns from the investors. Now, let us look into the financial performance of top 3 Singapore banking stocks and the investing strategy to be considered in 2021. First is DBS Bank, SGX trading code D05. In the past 3 years, DBS revenue is growing consecutively, but the growth rate is decelerating. From 2017 to 2018, the revenue is improved by 27.37%, from 10.8 billion Singapore dollars to 13.8 billion Singapore dollars in 2018. However, the revenue only increased by 0.33% from 14.5 billion Singapore dollars in 2019 to 14.6 billion Singapore dollars in 2020. At the same time, the net profit for DBS is showing a decrease of 33% from 6.3 billion Singapore dollars in 2019 to 4.7 billion Singapore dollars in 2020, as compared to increase from 2018 to 2019 by 14%. Based on DBS annual report, the significant drop in net profit is mainly due to allowances for credit and other losses provided, which is amounted to 3.07 billion Singapore dollars in 2020, as compared to 0.70 billion Singapore dollars in 2019. The allowances made is in line the current market condition and economy downturn due to the impact of COVID-19 pandemic. Also, another reason for the decrease in net profit is due to decrease in net interest income by 6% due to lower net interest margin, as central banks around the world cut interest rates in response to COVID-19. Net interest income contributes to approximately 67% of DBS total income. In terms of capital adequacy ratios, DBS remains strong, whereby the Common Equity Tier 1 ratio charges at 13.9% as loan growth was offset by capital accretion. The ratio is well above regulatory requirements as well as management operating range of 12.5% to 13.5%. Now we will be revealing on the investing strategy to buy this stock. Currently, DBS NAV is at 20 Singapore dollars and 8 cents per unit as of the 31st of December 2020, and the stock price is trading at 30 Singapore dollars and 50 cents as of the 29th of July 2021. This is considered relatively high trading price as compared to 5 years trend, whereby DBS stock only once hits 30 Singapore dollars and 76 cents in May 2018. Generally, DBS is trading at an average of 25 Singapore dollars, which translates to approximately 1.3 times PB ratio. As of now, its PB ratio is 1.5 times, which is slightly higher compared to prior years. Looking at the overall market, the economy is slowly in progress to recover from the impact from COVID-19 pandemic, and Singapore is recording 14.3% GDP growth in Q2 2021. Provided that the main income attributors, which are consumer banking, wealth management and institutional banking, are recovering well from COVID-19 impact, it is advisable to invest in this stock when the stock price is returned to approximately 1.3 times above NAV to be prudent. Nonetheless, one good news is that MAS announced in the 28th of July that the dividend restrictions on locally incorporated banks in Singapore will be lifted. This also another indication of strong capital adequacy ratios among local banks in Singapore. Next, let's look at the future prospect and developments to be considered for DBS. As the dividend restriction is lifted by MAS, we can expect a better dividend yield in 2021 as compared to 3.96% in 2020. Also, given the asset quality trends is healthy in 2021, allowance charges in 2021 would revert to normalized levels and earnings is expected to be higher in 2021. Moving forward, DBS will still continue their effort in digitalization and aims to become a technology company. In 2020, more than 99% of DBS applications are now cloud-enabled. Also, DBS NAV Planner, which is supercharged by SG FinDex in December 2020, is the world's first public-private open banking initiative, which allows bank to reach a wider pool of customers. This initiative allows DBS to retrieve customer financial information and provide financial planning purpose accordingly. Besides focusing in Singapore, DBS is also building their presence in big markets of China, India and Indonesia. In November 2020, Reserve Bank of India approved the amalgamation of Lakshmi Vilas Bank, LVB, with DBS Bank India Limited, DBIL. It complements DBS Digibank strategy with expanded network of 600 branches and 1,000 ATMs, an additional 2 million retail and 125,000 non-retail customers, as well as strengthened deposit franchise. DBS expects to be profitable over this amalgamation in a 1 to 2 years' time. In China, DBS is preparing to launch DBS Securities China Limited, a joint venture securities company. As China integrates with global capital markets, DBS gains opportunity to build their market. In the 30th of July 2021, DBS and Temasek jointly launched a $500 million growth stage debt financing platform for technology firms in Asia. The platform, named as Evolution X Debt Capital, will invest in opportunities arising from digital economy across sectors such as financial services, customer, healthcare, industrial and others. To summarize, DBS efforts are in line with their long-term future prospect, and as a dividend stock, it is good to invest for long run based on its future prospect, stable financial result and dividend yield. Second is UOB Bank, SGX trading code, U11. UOB is a leading bank with its network distributed across 19 countries and territories in Asia Pacific, Europe and North America. Over the past 5 years, UOB revenue is increasing except in 2020. Its revenue dropped by 9.3%, from 10.03 billion Singapore dollars in 2019 to 9.18 billion Singapore dollars in 2020. Also, its net profit dropped from 4.36 billion Singapore dollars in 2019 to 2.93 billion Singapore dollars in 2020, which is mainly due to decrease in net interest income by 528 million Singapore dollars and increase in allowance for credit and other losses by 1.02 billion Singapore dollars. UOB operating profit also dropped by 11%, from 5.6 billion Singapore dollars in 2019 to 5 billion Singapore dollars in 2020. However, if based on geographical areas, the operating profit recorded a growth in Indonesia, Malaysia, US and Europe markets, being offset with the decline in Singapore, Thailand and others. In terms of capital adequacy ratios, UOB maintains strong capital position whereby the Common Equity Tier 1 ratio charges at 14.7%, which is well above MAS minimum regulatory requirements. Now we will be revealing on the investing strategy to buy this stock. UOB NAV is at 23 Singapore dollars and 3 cents per unit as of the 31st of December 2020, and the stock price is trading at 26 Singapore dollars and 28 cents as of the 29th of July 2021. The stock price is trading approximately 1.14 times of its NAV. It is relatively consistent in the past. Based on 4 years consecutive financial information, UOB is trading at an average of 1.15 times of its NAV. In terms of dividend yield, it is showing accelerating trend except in 2020 where MAS imposed dividend cap on banks in Singapore. As of the 31st of December 2020, the directors proposed a final tax-exempted dividends of 39 cents per ordinary shares amounted to 652 million Singapore dollars, which will be accounted in 2021 financial statements upon approval of equity holders of UOB. Given dividend cap restriction have been lifted by MAS in July 2021, it's expected that the dividend yield for UOB will improve in 2021. In 2021, interim dividend announced by UOB as 60 cents per ordinary shares, which translate to dividend payout ratio of 50%. It is relatively optimistic to invest this stock at stock price approximately 1.12 to 1.15 times of its NAV, using long-term investment strategy. With a stable dividend payout, the annualized return for UOB in long run is approximately 10% to 12%. Next, let's look at the future prospect and developments to be considered for UOB. In UOB long-term strategic growth, they have significant investments in digital capabilities across various channels, product and services. For example, UOB Mighty, UOB Infinity and TMRW are some of their digital initiatives. Particularly, TMRW is UOB newly launched mobile-only digital bank in Indonesia, their second ASEAN market after Thailand. Also, UOB is looking at creation of wealth and investment solutions to their customers in future. For example, they are utilizing artificial intelligence, AI-powered investment analytics to analyze market trends and risk associated. UOB is planning on the implementation of new trade financing platform in 2021. All digital transformation efforts targeted to help them drive productivity. Third is OCBC Bank, SGX trading code, 039. OCBC is formed through merger of 3 local banks in Singapore in 1932. Today, OCBC is the second largest financial services group in Southeast Asia by assets, which represents a A1 rating by Moody's. Having more than 470 branches and representative offices across 19 countries, OCBC key market are in Singapore, Malaysia, Indonesia and China. The core businesses of OCBC are subdivided into 3 categories, which are banking, wealth management and insurance. For insurance, OCBC owns 88% in its subsidiary, Great Eastern Holdings, which allows closer collaboration and more coordinated initiatives between bank and insurance industries. OCBC revenue is improving since 2017 but showing a decrease of 7% in 2020. Similarly, its net profit is increasing since 2017, except in 2020, dropped from 4.9 billion Singapore dollars to 3.6 billion Singapore dollars. This is mainly due to decline in net interest margin and increase in allowance for loans and other assets from 0.89 billion Singapore dollars to 2.04 billion Singapore dollars amid COVID-19 pandemic. In terms of capital adequacy ratios, OCBC's Common Equity Tier 1 ratio was higher at 15.2%, as compared to 14.9% in 2019. It has performed well above MAS minimum regulatory requirements. Now we will be revealing on the investing strategy to buy this stock. OCBC NAV is at 10 Singapore dollars and 82 cents as of the 31st of December 2020 and the stock price is at 12 Singapore dollars and 32 cents as of the 29th of July 2021. This translates to PB ratio of 1.14 times. Based on past 3 consecutive years, its PB ratio is at an average of 1.14 times, which seems consistent with current trend. However, it could seem that the current stock price has bounced back to the level even higher pre-COVID-19 pandemic, with its peak at 12 Singapore dollars and 57 cents at the 10th of May 2021, right before dividend declared. In terms of dividend yield, it is showing growth since 2017 except 2020 at 3.39%, in line with dividend cap restriction guidance provided by MAS. Subsequently, OCBC declared 25 cents dividend payout in first half 2021 after dividend cap restriction lifted. Similar with the other two banking stock, long-term investment is the strategy to buy this stock. With a stable dividend payout, the annualized return for OCBC in long run is approximately 9% to 11%. Next, let's look at the future prospect and developments to be considered for OCBC. OCBC is taking their initiatives to accelerate their digital transformation through expanding digital ecosystem in partnership with fintech, e-commerce platforms and government to provide innovative financial solutions. In terms of resourcing, OCBC has introduced OCBC Future Smart program in 2018, with an investment of 20 million Singapore dollars to train and develop digital skills of 29,000 employees of OCBC Group globally. This program is the largest scale and most ambitious digital transformation initiative introduced by Singapore Bank. Also, the recent statement announced by OCBC Group CEO, Helen Wong, in July reported that an investment of 30 million Singapore dollars will be utilized in Phase 2 of OCBC Future Smart program over the next 3 years. These investments shows OCBC effort in accelerating digital transformation in future. Hope you can have some valuable insights on Singapore banking stocks after watching this video. Do comment and share with us your thoughts on the above points. Stay tuned and remember to share, like and subscribe our channel. I'm Sunny the Eggman. Goodbye.